Good morning! The U.S. markets are not yet open for trading on this Monday, October 20th, 2025. We are looking at Nuburu Inc., ticker BURU, which finished the last session on Friday, October 17th, closing at $0.343 per share. That was a modest gain of 0.0029, or about 0.85% on the day. But that small green candle is deeply misleading. It hides the chaos underneath. The real story wasn't the price change. It was the volume. Over 98 million shares changed hands on Friday. That is a staggering figure for a company with a market cap of only around $45 million. This isn't normal trading. This is a battlefield. And what's fascinating, what many people watching this stock on their Fidelity app or Robinhood account might miss, is that this company is in the middle of a desperate high-stakes identity crisis. You might think you're looking at a small, struggling laser company, but the reality is you might be looking at the shell of one company trying to become something else entirely. Let's establish the common ground, the general expectation. When any of us, whether we're using SoFi Invest or a professional interactive broker's terminal, see a stock trading for 34 cents, we think one thing: penny stock. We see extreme risk, a company likely circling the drain, burning through its remaining capital, and probably facing a delisting notice. The expectation is that this is a pure gamble. It's the kind of stock people buy a few thousand shares of, hoping for a 100% pop on some random news, not a serious long-term investment. It's the definition of a speculative bet in a self-investing portfolio, the polar opposite of what you'd find in a managed, intelligent portfolio. And for Nuburu, that expectation is built on a foundation of very real, very poor financial performance from its original business. Now let's challenge that expectation with the much more complex reality. The market narrative that this is just a failing laser company is dangerously out of date. The truth is, Nuburu's management is aggressively trying to pivot the entire company away from its original focus and into the defense and security sector. The massive volatility we've seen, a move from 12 cents in late September to a high of 65 cents on October 8th, only to collapse back to the 30s, isn't just random penny stock noise. It is the market trying to price in this audacious and frankly incredibly risky strategic shift. You aren't just betting on blue lasers anymore, you're betting on a brand new M&A roll-up strategy, a transformation plan being executed by a new dual CEO leadership structure. This changes everything. Let's break down that recent movement because it tells the whole story. For most of September, the stock was languishing near its 52-week low of 12 cents. The market had all but given up. Then, on October 7th, the company dropped major news. It announced a binding agreement for its new subsidiary, Nuburu Defense LLC, to acquire Orbit S.r.l, an Italian software-as-a-service company focused on operational resilience. The stock exploded, soaring over 86% in a single day, hitting 0.48 and running to 0.65 the next. This was the first proof that the new defense pivot wasn't just talk. This was followed by news that its partner, Tekne S.p.A, another Italian defense firm, had secured a $6.6 million contract in Bangladesh, a deal Nuburu claimed it was instrumental in supporting. For a few days, the new narrative held. The Robinhood app was likely buzzing. But then the reality of operating a distressed public company bit back. On October 13th, the stock began to slide, and the company announced it had received a warning letter from the NYSE American Exchange. Now, this is a critical distinction. This wasn't the dreaded delisting warning for its low stock price, though that remains an ongoing risk. This was a procedural violation. Nuburu had announced its new dual CEO structure on October 1st, 21st during trading hours without giving the exchange the required advance notice. It was an amateur hour mistake, and it looked terrible. It shattered the newfound confidence. It suggested a management team that was scrambling, not one in smooth control of its grand plan. The stock tumbled from its highs as traders who bought in on the defense news fled, fearing the company's governance was a mess. The company tried to stop the bleeding. On October 16th, just last Thursday, it issued another press release stating it had restored NYSE compliance and that the matter was administrative only. This helped stabilize the price, leading to that quiet 0.85% on Friday. But the damage was done. The stock had been cut in half from its peak. This is the whiplash that 98 million shares represents. It's a war between traders betting on the defense pivot and those who see a struggling company making procedural errors while burning through its recently raised $12 million in financing. This isn't the kind of volume you see in Apple stock or Tesla stock. This is the frantic churn of a narrative in deep conflict. People using Fidelity investments for their retirement planning wouldn't touch this, but day traders using the Fidelity mobile app for high-risk plays are having a field day. So, who was Nuburu before this pivot? This is the part that gets relegated to the back of the story now. Nuburu was a pioneer in high-power blue laser technology. This is actually very interesting tech. Traditional infrared lasers, which are the industry standard, are not great at welding reflective metals like copper or aluminum. They tend to splatter, creating defects. Nuburu's blue laser, due to its shorter wavelength, is absorbed much more efficiently by these metals. This allows for spatter-free welding, which is a huge deal for manufacturing EV battery components where copper is everywhere. They also targeted consumer electronics and 3D printing. The technology itself is impressive, with a solid patent portfolio. The problem? They never figured out how to build a business around it. The financials are a horror show. We're talking trailing 12-month revenues of just $9,300, not million, thousand. Meanwhile, their net income loss over the same period was nearly $45 million. The old business model was a complete failure. It didn't matter how good the tech was, it wasn't translating into sales. This is the reason the stock fell to 0.12. The old expectation that this was a high-growth tech company died, replaced by the expectation of bankruptcy. This is why the pivot to defense is so abrupt and so total. It's a break glass in case of emergency maneuver. They are essentially bolting a new, unrelated business, defense SaaS and contracting, onto the public shell of the old laser company. This brings us to the future outlook, and the tension between expectation and reality becomes the only thing that matters. The new expectation, the one management is selling, is this. The $12 million public offering in September provides the capital. The new dual CEO structure provides the M&A expertise. The creation of Nuburu Defense LLC provides the vehicle. The acquisitions of companies like Orbit and partnerships with firms like Tekne will immediately start generating revenue. In fact, the company has guided for billings of $500,000 in this current quarter, Q4 2025, from these new lines. They are attempting a complete corporate reinvention on the fly. They want investors to stop looking at the failed laser business and start valuing them as an emerging defense tech conglomerate. But the reality is that this is one of the hardest things to pull off in the corporate world. The risks are immense. First, cash. $12 million is not a lot of financing for an M&A-based strategy. It can be burned through very quickly. Second, execution. Can a board and management team that failed to commercialize their own world-class laser technology successfully integrate and manage a portfolio of other companies, especially in a complex field like defense SaaS? The NYSE warning letter, even if just administrative, does not inspire confidence in their operational discipline. Third, the underlying business is still bleeding. What happens to the core blue laser tech? Is it being sold off? Is it being repurposed for defense? Or is it just a cash-burning anchor while they try to build the new boat? This is the kind of high-risk play that online investing platforms like Robinhood and SoFi are built for, but it's a world away from a diversified Schwab intelligent portfolios. Here's a question for everyone watching. Comment below. Are you holding BURU for the original blue laser technology, or are you betting entirely on this new defense pivot? I'm very curious to see what the sentiment is. This is not a stock like Nvidia stock, where you're analyzing GPU market share and AI data center spend. This is a special situations play. The bull case is that you are getting in on the ground floor of a new defense company at a $45 million market cap. If they successfully acquire Orbit, and if the Tekne partnership, which supposedly has a $500 million order portfolio, yields real high-margin business for Nuburu, this $0.34 stock could be a 10-bagger. You'd be crazy not to put some speculative funds into it through your individual brokerage account. The bear case is that this is a Hail Mary pass. It's a company with a history of failure now trying to buy its way into a